Welcome to Market Today and our special edition of Market Gurus, where you get to meet the finest brains on Dalal Street, people who have navigated these markets over the last 2.5 decades, have seen the highs, the hurrahs, and the lows of investing, and have a wonderful ability to make you make money with the easiest possible routes and the best possible methods. We have a special guest for you today. She's Shibani Sircar, the Senior Executive Vice President, Senior Fund Manager, and Head of Research at Kotak Asset Management Company. A very warm welcome to Shibani. Shibani has been with Kotak over the last 16 years, from 2007 till now, has held various positions, and before Kotak, she's worked with UTI Asset Management Company between May 2000 and May 2006. So all put together, a wonderful experience of over 23 years is what is coming to you via Miss Sircar. A very warm welcome to you, ma'am. How do you see sentiment on Dalal Street at the moment, and how do you see the markets as of now? We've hit a record high on the Nifty, a bit of mild profit booking happening on Dalal Street. Is it something to be worried about?
Hi, good afternoon. My pleasure to be on the show. So when you look at our markets, we've had a great run. In fact, we've seen 8 consecutive years of positive returns for the equity markets in India, and that's a record. So if you look at and just take a step back and see how the markets have moved and what have been the key drivers, there have been 3 key factors driving markets. One is that India, from a macro perspective, stands out in the global context, and we have been like an oasis in the desert, where globally other economies, including emerging market countries, have seen significant challenges and headwinds, while India continues to grow. The second most important aspect has been corporate earnings. And if you look at the contribution of profits as a percentage of GDP, we touched a low in FY20, and since then it's been one way up, and therefore corporate profitability improving has led to the market movement, and a lot of the earnings growth is reflected in how markets have behaved. And the third aspect has been flows, specifically so the domestic flows, which have helped in terms of supporting markets. Now from here on, we do believe that if you take a slightly medium-term view, equity markets continue to be fairly constructive, because we believe that the corporate earnings trajectory helped by domestic facing sectors continues to remain strong, both for the current FY24 as well as for FY25. In the very near term, of course, one will have to contend with some amount of the valuation up move that we have seen, specifically so for the mid caps and the small caps, where today valuations are trading at a premium, both in terms of absolute as well as historical averages. So near-term volatility cannot be ruled out, but medium-term we remain very constructive on the markets.
Okay. Shibani, since you wear multiple hats within Kotak AMC, which manages about 73 funds and something like 3,70,000 crores in terms of asset under management, tell us the way forward. There is this consensus emerging on the Dalal Street that 2024 might be an year dedicated to blue chips, simply because mid caps and small caps have given such fabulous returns in 2023 that blue chip need to catch up. Now, are you a part of this camp? And if yes, what are the sectors within this particular segment which may outperform?
Sure. So, while you look at India as a market and as a economy, mid and small cap companies play a very, very significant role. And more importantly, when you look at the kind of valuation re-rating that you have seen in mid and small caps, that has actually been supported by significant improvement in earnings growth for this space. Having said that, in the very near term, yes, we are of the view that if you look at pockets of mid and small caps, there has been some degree of exuberance that has been built up. And therefore, one has to be a little cautious in terms of the kind of mid and small caps that you build in your portfolio, and taking a slightly longer term view. So from purely a valuation angle, in the near term, large caps do appear to be slightly better placed than mid and small caps. While of course, as I said, in the medium term to long term, mid and small caps do have a pretty important role to play. Now, from a sectoral perspective, what we have believed in is that if you look at the earnings trajectory, domestic facing sectors continue to contribute significantly to the overall earnings growth for the markets. So therefore, there are few key opportunities that we are playing out. One is the entire industrials, capital goods, infrastructure space. The second, especially now in the context of large caps and valuations, is the banking sector, specifically some of the large cap banks where valuations are favorable in context to their return on equity. The third aspect has been the auto and the auto ancillary space. The fourth has been the real estate and home building sector. And the fifth, incrementally, is the healthcare pharma space. So these are some of the sectors where we are positive.
Okay, that's one hell of a list to trawl through. But let me request you to wear a different thinking hat, and this time as that of a senior fund manager. Let's help our viewers in terms of allocating fresh capital at this point of time within the Indian capital markets. As we all know, there are about a dozen indices that are at record high levels. So this is a very difficult task. But let me just find out your views on a notional capital of 5 lakh rupees as a lump sum. How would you distribute them over blue chips, mid caps, small caps, sectoral themes, and probably a dash of international play?
Absolutely. So if you look at what we have been stating as a fund house, our view is that if you look at the overall asset allocation bucket, equities at this point in time, given valuations, one should be neutral in terms of equities. Now, when we say neutral, what we are saying is that you should not be selling equities as such, but if you have a certain asset allocation in mind on equities, you may look at booking some profits and coming back to a more neutral level on the overall asset allocation bucket, and then using dips to then build up back into the equity space. So that's the overall view from an equity perspective. In terms of different segments, we are slightly overweight on large caps, equal weight on mid caps, and slightly underweight where small caps are concerned, given the discussion that we are having from a valuation perspective. Now, in terms of sectors, and if you look at certain themes, two key themes stand out in our view. One is the entire manufacturing infrastructure theme, which we believe is a long-term sustainable theme for India going forward. And the second theme that we are positive on is the banking and financial services space, which has again not just been restricted to banks, but has become extremely diversified with different segments performing differently. And we believe that financialization of savings is something that is here to stay. And therefore, these are two large themes that we, would, in terms of our positioning in our portfolios, we continue to remain positive.
Okay, let me just rephrase that question. As a percentage of 5 lakh rupees, if it were a lump sum, where would you deploy the maximum percentage as at this point of time, ma'am?
Yeah, so as I said that, if you look at that entire lump sum, slightly more coming in towards the large cap space, or one could look at a large and mid cap kind of a fund where you get exposure on both the sides. Therefore, slightly overweight, in that overall basket towards large and mid cap sort of things in terms of asset allocation. But as I said that if you look at the overall asset allocation bucket, equities would be more or less neutral. And therefore, you would also have the opportunity to look at some of the other asset classes, which include gold, fixed income, etc., in the overall scheme when you're deploying the money as well.
Okay, let's get this fixed income part up ahead. There is this consensus view within the Indian macro system that RBI was holding back on cutting interest rates because the US Federal Reserve was actually on a cycle of increasing rates. Well, you have all signs that somewhere in March you will have the first cut coming in Wall Street. How do you look at the Indian 10-year yield, and would you estimate what kind of borrowing costs would be, say, by December 2024 in India?
Yeah, absolutely. So, while we do not give out a target per se in terms of a 10-year yield, but one thing that has changed post the last Fed meeting is that the Fed is now clearly indicating that even while labor market conditions remain the way they are possibly looking at a rate cut going into this calendar year. So, in fact, if you look at the way the markets are building in terms of probabilities of rate cuts, market is actually ahead of what the Fed in terms of their dot plot is stating. And some market participants are today building in maybe 6 to 7 rate cuts in this current calendar year. So it's likely that post March, there is a possibility that the entire Fed cycle changes in terms of rates. Our view is that RBI clearly is focused on bringing inflation down to the targeted level of 4%. And therefore, that is the primary objective where RBI is concerned in terms of monetary policy. So if you look at the way RBI has been, dealing with monetary policy, they have maintained an extremely good balance between supporting growth and also bringing down inflation. And I think that is the trajectory that RBI will continue to follow. From our perspective, we believe that RBI will possibly look at a rate cut cycle post the Fed, or will follow the Fed in terms of a rate cut cycle. And therefore, as and when the Fed starts cutting rates, RBI will also then, assuming that inflation comes down closer to the 4%, look at a rate cut cycle. So that's how we are looking at it. And therefore, possibly towards the second half of the calendar year, you can see rates come off, and that should also get reflected where the Indian 10-year is concerned. The other important factor to note for the 10-year would be how the fiscal deficit and the borrowing program moves. So far, the government has clearly demonstrated that they want to be on the path of fiscal consolidation, and that is something that we expect will continue as well in terms of the future years as well. And therefore, fiscal consolidation will also help in terms of yields going forward in the latter part of the year.
Okay, so much depends on how the fisc moves and how inflation is, and therefore their impact on rate cuts. Shibani, let's focus on your job as the head of research. Kotak, I have noticed over the last 3 decades, is one of the most aggressive AMCs that is there on the Lal Street, and it loses no opportunities when it comes to short-term as well as long-term opportunities getting reflected in funds such as the Equity Opportunity Fund, the Kotak Blue Chip Fund, the Emerging Equity Fund, and of course the Small Cap Fund. You've done a stellar job there. I'd like to find out what now. Is the job of the fund manager a little more difficult these days what it was 1 year ago, given the fact that almost everything is at a record high, stocks are rising like rockets, and multi-baggers are dime a dozen on the Lal Street? Is it a very difficult job to do on a really regular basis these days?
So I might, on a lighter way, say that I think fund management is always a difficult job. You have the fiduciary responsibility of managing money on behalf of others, and therefore, yes. Trying to understand how you want to invest. So let me just talk about, how we look at investing at Kotak Mutual Fund, and what we see in terms of opportunity sets. So while yes, markets have moved up, but what we believe is that even within the overall market, there will always be pockets of opportunity based on earnings and valuation. So at Kotak Mutual Fund, we focus significantly in terms of identifying companies which are structural in nature, where you can invest money from a longer term perspective. So for us, there are 3 key factors that have to fall into place. The first is business. We are looking at businesses which are gaining market share, where the gain in market share is scalable and sustainable in nature. The second most important factor for us is management quality and corporate governance, capital allocation, and whether management interest is aligned to minority shareholder interest. And that is extremely important in the overall scheme of things. And the third is marrying all of that with valuations, where we look at not just absolute valuations, but we look at the trajectory in terms of cash flows and return on equity. And therefore, when you're looking at a scenario, for instance, in our markets, where over the last 3-4 years, you've seen significant improvement, not only in terms of earnings trajectory and delivery, but also in terms of cash flows and ROEs, you need to look at market valuations in that context and not just at an absolute level. And therefore, I believe that at any point in time, there is always opportunities that you can find. And that's what the job is from a research perspective, to help fund managers identify those opportunities.
Absolutely, that's a textbook reply. And one point I'd like to make, since I've been watching Kotak AMC for such a long time, they've done a fantastic job in terms of delivering the same repeatedly over consistent number of years. If you look at the four funds that I've mentioned, the Kotak Equity Opportunities Fund, the Blue Chip Fund, the Emerging Equity and the Small Cap Fund, they are in the upper 2-3% quartile of their competitive peers in terms of giving consistent returns. Let's look at the sectoral play when it comes to the market, Shibani. Where do you see overvaluation at this point of time? What, according to you, has the market just ramped up ridiculously at this point of time?
So I would say I would like to answer this question somewhat differently. While of course in every sector there are pockets where there is overvaluation and things have moved slightly ahead of fundamentals. I think more importantly, one should be careful in this sort of a market, especially where stocks have moved up considerably on the back of low liquidity. Where float of market free float has been low and therefore stocks have been ramped up, or there are certain segments where market valuations are significantly higher than historic average multiples. So therefore one should, in terms of picking stocks, be careful in those particular pockets, especially where some of the small caps and mid caps are concerned, where because of lack of free float, there has been significant ramp up in terms of the way the stocks have moved, which has resulted in valuation multiples moving up considerably. If you look at the overall context of the market from a sector perspective, I would like to say that let's look at sectors where there is still valuation comfort. For us, a couple of that is firstly in terms of the banking space, specifically some of the large banks, where you've seen significant improvement in earnings quality as well as ROEs, but multiples are extremely attractive, especially in context of their historic average multiples. So that's one segment of opportunity set that we see. The other sector that we are evaluating, especially if you look at the technology space, while the mid-cap IT space now seems, in terms of valuations, somewhat stretched, especially in context with the large caps, the large cap IT valuations appear to be fairly reasonable. And of course, the sector is going through its own turmoil given the fact there is uncertainty on demand in the near term. But as the macro stability starts to come through, maybe sometime next year or next financial year, large cap IT can also see a segment where valuation comfort is there on your side. So that's how we are pretty much looking at valuations across sectors.
Okay, so the two spaces that you've mentioned where pickings can be rich are, of course, the private banking space and large cap software companies. Even today, there was a lot of pain in this particular sector, and much has been said about, the recession in the US, which never came, but it was.
No, but those are the two spaces.
And maybe once those. Yes.
No, I meant those are those two spaces where valuation comfort is still there. So those are the two spaces where valuations are still in your favor.
Absolutely.
Yes.
Yes, I agree with that. Let's, ma'am, look at the other part of the market. And traditionally, fund managers who've been, in the market for about 2.5 decades have mentioned their consistent disappointment with the PSU space over the last 15 odd years or so. But here is a segment which has given the most stellar returns in 2023 when you watch them as a group. Has this rally overextended itself and it's welcome, or is this a new dawn, a new era, simply because of how the political landscape has shaped up at the center?
So the PSU rally has been led by two key factors. One is that there has been policy stability, and of course there has been significant change in terms of policy, with the government focusing on profitability even for PSU companies, and therefore some of the companies which have seen multiples re-rate or valuations move up has been on the back of certain policy changes which has focused more in terms of ensuring that these PSUs get back into profitability, and PSU banks is one such example as a pack. The second key factor is that, given that the current political landscape seems to suggest the continuity of government, and therefore that means that the policy initiatives that have been taken so far would likely also continue, and therefore that is also driving, the valuations within the PSU basket. Now, the way we look at it is that today, when you look at PSUs across segments, so whether it be, gas utilities, OMCs, PSU banks, power, across the basket, the PSUs need to be evaluated in each of the segments in which they are operating in. And therefore, given the fact that we have seen a significant rally in the space, one has to be now selective in identifying PSUs where you still see chances or the ability of these companies to deliver in terms of better return ratio profile as well as earnings profile over the next few years, and then marry that with valuations. And therefore one would have to be more selective in terms of the kind of PSUs that you choose. So there are a few pockets where we do believe that there is opportunity set. First is within the PSU banking pack, there could be a few of the larger PSU banks where you still see ROA improving over the next couple of years, which should support valuations. Second would be in the power utility space as well as power financing space, where there has been considerable improvement in the sector. And the third would be defense, where again the momentum in terms of order flows translating into better earnings profile continues to remain.
Okay, this is such a precise reply that my next question has already been answered without me uttering a word. Kudos to you, Shibani, for sort of reading my mind from 1100 kilometers away. I just wanted to understand the sequence where we still have value to be had in the PSU framework. So, ladies and gentlemen, PSU banks. Remember, I just read an interesting report today, Shibani, which said that the State Bank of India is all set to post profit after tax for this financial year exceeding somewhere like 62,000 crores. That itself is such a huge number, and the bank itself hasn't done much. So, full marks there. I just wanted to understand this markets affair. Actually a long-term affair which is now taking place with the defense space. Pick up any stock, it's become a multi-bagger 3-4 times in 2023, and even now there is no let up. You can't have a 3-4 day correction in any stock price before it being purchased. What's happening here? What enthuses fund managers such as yours to, how should I say, boldly go where normal investors find it a little hard to justify valuations?
Absolutely. So you picked the right quote from Star Trek. And if you look at the entire defense space, the two key factors that have changed and which has led to the way the sector has performed. One is the key focus of the government in terms of indigenization of defense and therefore the entire opportunity space. And the second factor is that globally, we've seen that demand for defense equipment has been on the rise. And therefore, while it is less talked about, there is a large export opportunity that is also opening up for many of the companies here. Now, while the opportunity set is extremely large, and that is reflected in the way the order flows have been for some of the companies within the sector, and therefore translating into growth outlook remaining fairly buoyant maybe over the next few years, one has to therefore also keep in mind at this point in time valuations. And therefore, while we continue to remain positive on the sector, valuation run-up has been extremely sharp and has been quick as well. And therefore, incrementally one should be somewhat selective in the space. But the opportunity set for defense, I think, remains considerably large. And as I mentioned, while we are talking about indigenization of defense, the export opportunity is something that is possibly not built in. And therefore, some of the earnings surprises could come from that space, which could help in supporting valuations as well. But overall, we believe that the opportunity within the defense space is long-term in nature, and we are positive on the sector.
Okay, so that's a bit of a relief. Given the fact that we have a sectoral fund from one of your rival AMCs, which has done fantastically well over the last 7-8 months or so. Coming to the financialization of our savings, Shibani, 2023 has been a revelation in terms of lot of stocks, really going stratospheric. There is the Bombay Stock Exchange. There are a couple of listed broker entities. There are service providers at the back end for mutual funds, as well as the broking community, that have done fabulously well. Is this a theme which has a multi-year scent to it? And if yes, then where is your money moving into?
Yeah, absolutely. So we do believe that financialization of savings is a multi-year theme. And if you look at the entire financial services landscape, the landscape itself has changed considerably over the last 3-4 years. So earlier, when we used to talk about financial services, we only meant banks, and specifically maybe if most of the private banks and a few public sector banks. But over the last 4 years or 5 years, we've seen significant amount of new listings in the space, which means that the entire universe of stocks within the financial services environment now includes banks, NBFCs, small finance banks, a capital marketplace, asset management companies, brokerages, life insurance, general insurance, and the like. The sector has become large. Also, more importantly, the sector is fairly heterogeneous in nature. That means different aspects or different parts of the sector now don't move in tandem and therefore move differently. And hence, active fund management helps you in generating alpha within the space and within the sector. And I think that's the key change that has taken place where financial services is concerned. The second most important factor is that if you look at any segment, whether it be banking, asset management, brokerage, or insurance, penetration levels in India are extremely low, even in context with other emerging market countries. And therefore, the runway for growth is extremely large. And the third aspect is, of course, as GDP continues to grow, financialization of savings also continues to grow. And therefore, this is a segment or a theme that we believe is here to stay and is going to be a multi-year theme. Of course, you need to pick the right segments within the overall financial services basket.
Well, Shibani, these days we joke here in Delhi, pick up any stock at 3:25 p.m. Next day morning, it will be up 3%, and if you pick up any PSU stock, it will be up 5%. Well, that's the beauty of the bull market, which is unfolding in front of us. Time is short, therefore, I'll ask a couple of final questions to you. What could go wrong? We've had this wonderful Goldilocks scenario for the last 18 odd months or so in India. Everything seems to be clicking in place. But is there something that nags you at the back of your mind late night when you look at this wonderful, wonderful bull market in front of us?
Absolutely. Thinking of risk and what could go wrong is also very much part of the fund manager job, and it's something that we keep thinking of all the time. Some of the key risks that we need to watch out for. India, while has performed well in the global context, remember, India is not an island, and therefore what happens globally will have some impact and rub off on India as well. And therefore, geopolitical risks is one big risk that we need to watch out for going forward. Specifically so, since it does have an impact where commodities are concerned, and therefore India being a large consumer of commodities, including oil, geopolitical risks would be number one in terms of the risks that we want to keep a close eye on. The second aspect is corporate earnings and delivery on earnings. After a long time, we've seen corporate India actually seeing earnings upgrades instead of downgrades, and therefore if you look at India in the emerging market context, India stands out as a country where a lot of the market movement has been led by earnings growth and not just by multiple re-rating. And therefore, for Indian markets, the delivery on corporate earnings remains one of the key factors to watch out for. And finally, I think continuity in terms of policy. The good factor is that it's likely that the current political stability remains, and therefore policy momentum continues, and that is something that would help in terms of market movement going forward as well.
Okay. With that, Shibani, we draw to a close on what has been an excellent 32 minutes worth of conversations. Thank you so much for your time. It was extremely enjoyable, and more than it being enjoyable, it was a wonderful learning experience, trying to understand how Kotak Asset Management Company is navigating this fantastic bull market. Thank you so much for your time, and all the best wishes for a fantastic 2024 compared with what has been in 2023. Thank you so much for your time.
Thank you so much. It was an enjoyable conversation, and all the best for a wonderful 24 to you too, and all your viewers as well. Thank you so much.
Yes. Thank you. That, ladies and gentlemen, was Shibani Sircar elucidating on how Kotak Asset Management Company is navigating this fantastic bull markets. They have three major themes, which is manufacturing, infrastructure, as far as the ongoing bull market is concerned, the banking and the financial space, as also financialization of savings, and of course they find valuation comfort in large private sector banks, as also large cap IT. We do hope this program has been of some use to you. Do stick around on Business Today for all your news updates. Thank you so much for your time.